Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today adds a bit of difference to the conversation that we do because he tracks the emerging market space very, very closely. From his earlier avatar of being an India dedicated fund manager to now looking at the emerging market space at large at Breakout Capital Advisors. Managing partner Swanand Kelkar with us on the show. Swanand, great having you. Thanks for taking the time out.
Thanks, Niraj. Always a pleasure.
The pleasure is ours, Swanand, because it becomes imperative to talk about the expertise that you bring to the table now. Not that you didn't bring it earlier, but now even more so, simply because the last 2 weeks, Indian markets were not at the mercy of, but certainly got impacted by a lot of chatter around how some of the India dedicated funds either got liquidated or wound down and the selling that happened, and the long-standing conversation about how EMs at large are not getting so much of capital because of the China factor. Just give us how does somebody who invests across EMs look at that space currently, and then we'll get to whether India can break out from the EM basket, if you will.
No, thanks. So I think I cannot bring any expertise to a 2-week trend either.
Of course.
So let me get out of that first.
Yeah.
But I'll talk a bit about emerging markets and what's really happening, because in India sometimes you are so preoccupied with what's happening within our vibrant markets that you don't look at what's happening elsewhere, and rightly so at times. But what's been happening in EM, and it's a very diverse asset class, multiple countries, there are 2 or 3 things. One is that over the past, maybe over a decade, EM has got their balance sheet act cleaned up. And that's across households, corporates, and in most cases, even the public debt. So I'm not talking of China here, I'm talking about most other EMs apart from China, which is a very good thing for starting a new cycle, that your balance sheets are much more clean and much more lighter than what they were, let's say, 10 years ago. The other advantage I feel for EMs is that the inflation experience in EM has been much more benign than what it has been in the developed world, and that's a divergence from what it was maybe 2 decades ago. So even if you look at the quantum of rate hikes, right, that have happened in the developed world versus what has happened in the EM, if you look at where the inflation numbers are, most EMs today are running positive real rates, which means that the inflation is much lower than the policy rates in those countries. Again, a good starting point that eventually when things fall in place, Fed starts its rate cutting cycles, a lot of EMs will follow. And that will set the base for an EM cycle again. And the third thing, of course, is valuations. I mean, it has been one of the most ignored asset classes, as you would know, for the past decade or so. I mean, we had the 2003 to 2008 EM rally, and since then, not much has happened, really speaking, within that asset class. Some justifiably so, some not so justifiably, because all eyes were on the US. People have made, which has been the US's decade, the last entire 10-12 years. So that's the starting point for an EM. If you, as a stock picker, if I tell you that, okay, the balance sheet is light and clean, there seems to be some sort of a growth angle which can now come up, and valuations are cheap, is the time that you start looking at such a stock. And that's exactly what is happening. So we have seen some money trickling into EMs over the past maybe 6-12 months, not in a big way, but there is at least some attention coming back to the asset class. India, of course, within that whole thing had stood out remarkably for the growth characteristics that the country has and the differentiating characteristic of the domestic flows, which are not present in most other EMs, at least in the quantum that we have had them in India over the past 5 to 10 years.
Yeah, a bit of a differentiating factor for sure, even to India's relative history as well, Swanand. But just one more follow-up there. Do you believe, I mean, because I heard you say that the factors that you enlisted will help an EM rally. You invoke 2003 to 2008. I'm not saying that is what will happen, but do you foresee a probability that in this decade we'll have an EM rally wherein all EMs could move up at the same time? And would a global rally be necessary for something like that?
Oh, interesting question. So if you go back to that 2003 to 8 golden period for emerging markets, right, there was a EM growth model, and that EM growth model predominantly was about exports. It was about exporting to the developed world, and there was commodity exporting emerging markets, which sort of fed into what China was doing, their huge fixed asset creation which was happening in that country. So those were the 2 EM models which could synchronously take the entire asset class up. India then, if you remember, the index weight for India and MSCI EM was mid-single digit. It's almost 18% now, right? So it's a very different EM as an asset class that you are looking at today. But you ask a very valid question. I think this time around, there isn't one overarching single EM growth model. There will be different countries which will have different interesting drivers, but there isn't a single model which will lift all the countries together. So there will be a domestic demand-driven model in places like maybe India, Indonesia. A country like Vietnam is still pursuing the East Asian tiger model of exporting to the developed world. There will be countries where there is sort of a value angle to them. I said that EM is trading cheap. There are at least 4 or 5 large emerging markets which are trading at single-digit PEs, where you get the basic inflation growth dynamic on an even keel, and you get some sort of an EM re-rating or the country re-rating. So I think it's a very diverse EM model now versus what it was in the last cycle, which is why you need to have a bit of active stock picking. I'm selling my book here, but which is why you need to have a bit of active asset allocation at a country level as well as stocks level this time around.
Okay, and a follow-up to that is, I heard you say, for example, that Vietnam is following the export-driven model, not everybody else is. So would therefore select markets like India and others be chosen by an EM fund manager for the domestic demand that it brings to the table, or also because of this whole conversation, Swanand, over the last 24 months about what China +1, Europe +1, etc. brings to select countries like maybe India and others, that they will export what China used to export, they will export what Europe used to consume and make in Europe, but now being made on their shores.
Interesting. So again, when an asset allocator allocates money to a country, it's rarely a single bullet point sort of a rationale, right? So you don't allocate money even to Vietnam only for their export model. Vietnam has a very buzzing tourism sector, as you know. So there are always multiple growth drivers in a single economy. Having said that, India is one of the few places which has a large domestic consumption base, which also still has a fairly large catch-up to do in terms of the capital stock within the country. There will be places where exports, China +1, Europe +1, manufactured exports, services exports even, which is done much better than manufactured exports, I would argue, would be part of that rationale, would be part of the portfolio. But I think that single factor model, which drove growth of some of the East Asian tigers, I think India will have many more growth drivers than just a single, like a single economic factor.
But it is not purely largely domestic demand, or that's not the overarching majority overweight for which you might choose India. It's a combination of domestic demand plus export prowess plus some of the other factors.
Absolutely. So it's all of these put together. In fact, some of the listed domestic consumption names now, since we are talking about India, and you know those names haven't done well at all versus what the country's growth numbers have been. So people have allocated capital even within the country to diverse growth models, which is one being the capital investment model, a bit of the manufacturing export model that you talk about, or even the services exports model. So I think it is a very diverse set of portfolio themes in every large foreign investor's portfolio, rather than just one single theme driving the entire portfolio.
So I was fortunate to be in the Berkshire meet this time around, and when I was speaking to some of the global investors out there, they were saying that they really like the India story, for example, very enthused by it, but not convinced at the price that they were paying for that. Now, because you have a choice of investing across markets, do you still find value as a global investor, I'm saying, to put money into India at these valuations because of all the promises that India has, or are there better options in the EM basket, growth versus valuation argument?
Yeah, no, absolutely. So you take a step back here, right? Again, you do not run an emerging markets portfolio allocating 60-70% to a single country.
Of course.
There are different flavors that you have within your entire portfolio, and that's true even, let's say, think about your individual portfolio. There will be a growth darling, and there will also be a value pick or a turnaround pick which you have in your personal portfolio. When you think about it from an emerging market standpoint, you do exactly the same thing. So the blue chip prom queen of emerging markets today is India, and most emerging market portfolios will have overweights on the Indian, I mean, those who are linked to the benchmark we aren't, will be overweight on the India weight in their respective benchmarks. But having said that, a lot of people tend to also ignore some of the turnaround that is happening in some of the smaller emerging markets and the valuations at which some of these things are possible. I don't think we'll ever say that this market is 20p, so we will not put in any money there. We are not big fans, frankly, of looking at index level PEs. If you ask me, is there anything different that I'm doing about India? I would say no, it is business as usual. I'm looking at business models, I'm looking at valuations, I'm looking at growth prospects, what I would do and have been doing for the past almost 15 to 20 years now. It's become slightly harder to get stocks for the valuations that you want them at. Yeah, true, but this has been our operating state in India for a long time, that what you like and what's discovered is priced very quickly. So I don't think it is any different from that sort of a scenario. It is business as usual. It is a bit harder to pick stocks than maybe it was, let's say, 12, 18 months ago. But you keep at it. That's what you're paid for.
Yeah. As Swanand had told me once in a show that we did in Alpha Moguls, when you look at headline valuations, Swanand said, you do not have nifty futures in your portfolio. You have stocks. So try and look at those stocks in your portfolio. And I like that term, blue chip prom queen for India. That's great to know. Now, my final question, and then we need to take a break. But my final question is, so let's say India has this 18% EM weightage. Let's say you're not a passive investor. Would you be over that weightage, looking at the current valuations? Would you still go over that 18% benchmark weight on India, or would you be under?
So we don't compare ourselves with the benchmark, but we are overweight. In our portfolios, we are overweight above that 18% number, although that's, as I said, we are absolute return investors, so we don't really look at. So we have been able to find enough opportunities that meet our investing philosophy to deploy anywhere between 20 and 25% of the portfolio in India. That's where we are at. I don't know about others, but that's where we are at.
So Swanand, good to know that an EM fund manager is constructive on India, and while you're not looking at benchmarks, you're still higher than the benchmark weighted. So that's great to know. The question would be, would you believe that India is indeed in the Amrit Kal of growth, if you will? Can this decade be a decade of secular growth? It may be a percentage shade here or there or whatever, but is it a secular growth story?
So I've always shied away from taking decadal calls on things, right? I always say that as an investor in any country, your investing horizon, typically when you talk about a stock, is somewhere between 18 to 24 months. That doesn't mean that you sell a stock in 2 years. What it means is when you write a rationale for buying a stock or allocating money to a country, you typically write an 18 to 24 month rationale. We have written those 18, 24 month rationale and kept holding stocks for 10 years because we have revisited this rationale and has done well and done well. So it's very hard to do a 10, 15, 20, 25 year sort of a prediction. But India valuation premium also comes from the fact that people feel that growth here is secular, right? I mean, there are certain markets where they peak out at 15 PE. They peak out at 15 PE because they're by nature very cyclical markets. Growth is very, very cyclical, or the composition of the index is very, very cyclical. That's not true for India, and there are very few other markets in emerging world which will have that secular nature of growth, where you can say with some degree of confidence that from even 5, 7, 10 years from now, the broad growth metrics or the broad growth engines will still be intact. Anything can happen, but investing is a game of probabilities. And if you think about those probabilities, so one of the reasons why you get that PE premium is just because the ROE is higher versus the rest of the world, yes, but also the longevity or the perceived longevity of that growth and the returns number gives you that higher multiple, which answers your question. I mean, do you think that growth sustains for the market is telling you yes, so you're paying that multiple because the market feels that this growth is long lasting and will sustain for a longer time than some of the other very cyclical markets.
No, because you don't have a very large India portfolio, because your portfolio also has a lot of other emerging market stocks, right? You would be choosing your ideas even more carefully. I would love to understand where is it that you find the most favor from a 24-month perspective.
So I'll tell you the framework that we employ first, right? So we think about quality, growth, and valuation in that order.
Okay.
Right? Because we are an absolute return fund, 100 going to 95 gives us nightmares, right? Even if that 100 doesn't go to 150, it goes to only 120, we are still okay with it, because the agreement that we have with our investors is to provide an absolute return for their liabilities or for their commitments. So that becomes the framework of stock picking, where we are very, very first concerned about what are the downside risks. Are there any stroke of the pen risks here? Can anything change overnight which will cause the stock to be down 20-25%? And even if there is a 5-10% probability of such an event happening, no matter how promising the growth prospects, we'll steer clear of those stocks. Now, this isn't an investment philosophy that everyone has. A lot of people look at equity markets almost like lottery tickets, right? There's a 99% probability of losing everything, but there's a 1% probability that I'm going to become a millionaire. Good luck to them. No comments or no judgment on that way of investing, but our way of investing is where we want to first protect the downside. Having said that, I think the last time we met, I said that the consumption side of the economy versus the investment side of the economy, we have been very clearly on the investment side of the economy. And that includes real estate, that includes the public sector spends that have happened in multiple areas. That still remains the tilt of the portfolio, where we are more focused on the investment side rather than the consumption side of the economy. We have also engaged into these new age companies which have now swung their metrics more towards convincing people that we are profitable. That swing to profitability mantra or the focusing on profitability mantra, a lot of these new age companies have realized very quickly, and that's a function of, I think, their beholders changing. When they were in the private world, if you remember, TAM was the buzzword, right? Everybody talked of total addressable market because that's what the then beholders care for. After being listed, the now beholders care for EBITDA, and they care for cash flow, and they care for profitability. And the smart companies, I think, nicely pivoted their business models to align to these new set of beholders, and we have taken note. These are more value shift sort of plays rather than a fresh value creation sort of plays, where across a supply chain or across a chain of where value gets captured, the digital beneficiaries are sort of making the most of it. That is the other thing. We like telecom as a space in the country. I still think it's a fairly non-consensus thing to like even today, which is where we are saying that, okay, we are getting a 15% growth sort of a sector where price repair is still ahead of us. Which is still not happened with the lowest rates in the country, etc., and a very supportive regulatory environment, at least for now. So the sector has come like emerging markets after a decade of, being at the receiving end of a lot of things, and I think that repair is underway. So we like that space as well. So
service provider or ancillaries or pure play telcos? Pure play
telcos. I mean, you can guess. There aren't too many. Aren't too many out there.
No, there are a lot of people and emerging market funds which have taken bet on the one that is coming up, or the tertiary beneficiaries as well, which is our
absolutely. So I think that is one pocket of consumption which we think has gone through a decade of, I think, underperforming on multiple metrics, which is now looking better. Which is what we like. So investment side of the economy, we are still not absolutely sure whether private capex has picked up. The public sector capex has done really well. The numbers are there in front of you to see. SOEs have not been spending, even that is fairly clear. But I think private capex, where almost it feels like as a market we are willing with the private capex to look up. So if you zoom a certain chart, you might see some uptick, but it's not there yet, and that's something we keep watching, because there is a limit to which the public sector capex can take the country. The private sector capex has to sort of step in its place. So I think those are the areas where the portfolio is aligned. I think conspicuous by absence would be private sector banks, which are, I think, a mainstay of lot of portfolios.
And why so?
So it's a bit of a longer term reason, where we feel that given the rate hikes that have happened across the world in the past 2-3 years, the easy advantage of CASA that some of these banks had, right, that you basically got money for free, that is under challenge, because people are switching money from there on to multiple other avenues which are yielding better. So your raw material as a bank has just gotten more expensive. And on the lending side, I feel that the lending in India over the past maybe few years has become very lopsided, which is more towards the consumer, even they're more towards the unsecured, and the regulator is telling you that please look at it. It's being cautious on that side of things. And the last 12 odd months, I would say, was the best of multiple worlds for banks, right? NIMs were at their best, credit quality was at their best, credit growth was in double digits. From here on, some of these things start turning at the margin, and that can't lead to a re-rating from here. So that is why private banks, which is I think a mainstay of many portfolios, doesn't find a lot of space in ours.
That's pretty interesting. Just one final question, Swanand. For a lot of these capex beneficiaries, right? There is a chalk and cheese behavior wherein some with a technology moat or a client moat or process moat. I mean, I'm not asking you to name, but I'm just using an example here.
Yes.
An ABB
Yes.
priced to perfection and beyond,
Yes.
because the market believes that
Yes.
no, this can do no wrong,
Yes.
and therefore okay to give it 75, 80 multiples
Yes.
as well, or Siemens, whatever, what have you.
Yes.
And the other end are the smaller names, not global parentage, but doing decent work, not getting priced. My question is, if you had to bet, if the private capex were to come, and if you had to take a bet, would you take a bet on those quality? And since the valuation parameter comes third, would that be a preference, or would you look at the valuations, because some of these are also not doing bad work?
Absolutely, I agree. So when it comes to valuation, we ran this analysis some time ago that almost a third of India's top 100 stocks were trading at more than 40 times multiple for 1 year forward. That number might have gone up as well now. This 40 times 1 year forward is a number where we kind of our hands start shaking as investors. We are not very used to it. We are not very, sometimes as they say, right, experience sometimes in bull markets is a liability. So that sometimes happens to us, that we have seen some of the same names trade at 10, 15 PE, and yeah, fundamentals have changed. I can understand all the arguments. But that is something that we have a, I wouldn't say a value mindset, but at least we are mindful of valuations, where we kind of balk at buying some of these names. That also means is that you have to then make a forecast of where you think private capex is picking and who will be the beneficiaries. And we have opted not to do it at this juncture. We own a large EPC company in the portfolio, and if you have seen the recent results, you would realize that bulk of their orders are coming from overseas.
Yes.
And coming from Middle East and coming from hydrocarbons. So that basically tells you that this widespread private capex that you were expecting to come about, at least in the bellwether companies' numbers, you're not seeing it. So again, the last time we met in Alpha Mughals, we discussed this, right? I mean, themes and trends are multiple going around at different points in time. And some of these themes, if they play out, they are multi-year themes. We are happy to miss out the first couple of quarters of that, but we would rather look at a validation of that theme before getting something into the portfolio.
Great. Well, afraid we are out of time here, but Swanand, such a pleasure talking to you. Thanks for taking the time out and speaking to us.
Likewise. It was a pleasure.
Yeah. And viewers, thanks for tuning into this very interesting and a slightly different episode of The Talking Point.